Welcome back to another episode of FPO&G, Financial Planner for Oil and Gas Professionals. This week on the podcast, we are going to do a lightning round. We're going to cover the article about home sizes and happiness and are those things correlated. We're going to talk about the California's wealth tax, and then we're going to talk about energy company performance in 2025 and just some takeaways and observations there. Justin, you want to set the stage for the home and happiness article from the Washington Post?
Would love to. Thought it was an interesting piece from Washington Post. The general idea is that small homes can lead to a happier life experience. And Jared, I feel like both you and I have some experience in this. And so I'd love to just first hear from you. Do you agree with the premise?
I would say yes, but in the same way that I agree with the happiness research. So there was a study in 2010 done by Daniel Kahneman that looked at the correlation between happiness and income. And they were positively correlated about $75,000. Again, 2010 numbers. So if you inflation adjust that, that's a very
way
different.
Higher today.
Yeah. Okay. So with that aside, but up to a certain amount, it's basically correlated, and then the correlation breaks down. And that intuitively kind of makes sense as you have your basic needs met and you have financial security, right? Albeit various definitions. I'm not dealing with food insecurity. I'm not dealing with housing insecurity, right? As those things rise, I should be happier. But then, once I have my basic needs met, there's a lot of rich people that are miserable, and there's a lot of people not much that are pretty happy, right? So I think the home math kind of also probably tracks, right? If you have a family of the people writing this, it's like a family of 4 living in less than 1,000 square feet in New York City. Hats off to you. I think if you had 500 square feet, I don't think your happiness would go down.
Yes.
I would probably say I agree with it directionally. I don't think happiness matters as much as we think. Like if you compare somebody with 2,000 square feet and 4,000 square feet, I don't think there'd be a correlation. But I think let's say we'll use family of 4, 0 to 2,000. I think there's probably a positive correlation, and then it breaks down. What about you?
I love that. I think this topic's really important because if you're talking about your personal financial plan, your house has the ability to make you happy and it has the ability to make you miserable, right? And this is now amplified just because the price of housing has exploded and the price of interest or the level of interest rates has changed drastically in the last 5 years. So we are now in a scenario, and Jared, this has always been true. There have always been people that have overbought, they've stretched themselves too thin, and that has materially hurt their financial situation, and it's potentially blown up their marriage. I believe that money problems is still the number one listed reason for divorce. So it in many ways, it has always had the ability to kind of mess up your life in a negative way. But if we're just speaking on happiness, I completely agree with you. I think that every bit that you get larger in your home from, 0 to, I will go 2,500 square feet. Maybe that's because I have 3 kids. I think it is a massive happiness improvement. You see a huge increase in your enjoyment in your home as it goes from, say, 1,200 square feet to 2,000 and then to 2,500. Jared, I think you see a little bit of happiness jump from 2,500 square feet up to 4,000, 4,200. I think after, mid 4,000s, there is no increase whatsoever.
The marginal utility curve of square footage.
Yes, that's right. And I also think there's also a number, I'm not totally sure what it is, to where it absolutely removes happiness and it negatively impacts your life when you add more square footage.
Yeah. I also think it's important we take a step back and say, how did we get here? I think it's interesting because if you look in the article, the average home size square footage is up about 40% since 1970, despite the average household size being down 17%. Right? So our family units getting bigger aren't what's driving the houses. Again, it gets back to this theory we talk about, the private equitization of everything. Right? If I'm a builder and I can build 20 small homes or 10 larger homes, I get the same amount of square footage, but that's fewer blueprints. That's, less infrastructure that has to be laid, right? There's more economic incentive to build bigger houses. And that's exactly what we've done.
That's right. I've seen this recently too. I had to go to an event in way North Texas. So this is within 20, 30 miles of the Oklahoma border, Jared. And I was blown away because there was massive amounts of new development of tiny homes. And so they're building these like tiny homes legitimately 70, 80 miles north of Dallas and anywhere closer to a major metro area. The only new development is extraordinarily expensive. And so, there's just, if you want to live, like I'm thinking about us here in Fort Worth, if you want to live within 10 miles and you talk about the new neighborhoods, well, they're neighborhoods that are building, 5 to 10,000 square foot homes for multiple millions of dollars. And so it just totally changes the dynamic of what's affordable because any small home, there's really no one's building those.
That's the thing is like, it's really like as simple as like, why, right? Like if you have to get back to your reasons, like why do you need the amount of square footage that you have? And that's like a really interesting existential question to kind of ask yourself. There was a quote I pulled out that I really love. And it says, does your home and neighborhood act as a center of gravity for your friends and family? Or does it isolate you in favor of status and storage? Right. And like, I actually think this, kind of you and I both agree at some point it breaks down and it's more about your motivation for that.
That's right. Although I want to admit something, Jared. So, I am saying right now that I'm a firm proponent that I actually agree with Washington Post and that, being in a 2,000 to 2,500, right now my house is 2,900. And by the way, it saw a massive kind of happiness increase going from the home we were at prior to this one. But Jared, I'll admit, we're thinking about just different additions, remodels, and it has entered the equation of, well, maybe we should do this plan that adds square feet because we're going to get our money back on it. So like the market and the potential investment on additional square footage pays off. So it's interesting.
Yeah. And I think like it's one piece of the equation, right? Like for me, like I am in 1,800 square feet. And again, I live in a historic neighborhood, bunch of 100-year-old craftsmen's. That's kind of par for the course, right? All these homes are wonky layouts, smaller builds, not much over 2,000 square feet, smaller lots, but it's walkable, right? And like one of my favorite things about the place that I live is I'm one block from the playground that I take Ellis to. I can walk to the office, restaurants, bars, coffee shops, all that stuff. And so like, that is really important in terms of my satisfaction with where I live, but doesn't show up in the square footage number.
That's a great point. Location is going to probably be way more important than size if you have even like remotely enough size.
Exactly. Yeah, so long as you're not at the front end of the curve. I think one interesting application is for oil and gas retirees before we pivot to the next topic. I think like a lot of people fall in, or retirees in general really fall into this trap of like, hey, I've changed homes. I want to have a spot where I can host the family. And then you end up with 4,500 square feet and the probability of the entirety of your family being in the same place,
once a year tops.
And it has never been easier to just basically buy that space for a finite period of time via Airbnb.
Yeah.
And right, like it's one thing if like that's the home you and your family grew up in and there's a lot of memories attached to it, but it is just kind of an interesting exercise of like, do I really need this for that scenario when that scenario is such a minor portion of my existence, right? We see retirees kind of on two different camps. Some will kind of downsize and just kind of simplify, or hey, I'm just going to rent a spot for my family, which is definitely the more cost-effective way to do that and kind of make your day-to-day life easier. Or if you're in the house that everyone grew up in, you might just stay there. So it's kind of interesting to see people take different approaches there.
Right.
All right, Justin, let's talk about the billionaire tax, which I know you're just going to be a super big fan of. I don't know much, but I know that you're just going to be geared and stoked to talk about it. I'd love for you to just summarize it and then just give some general thoughts on it.
Absolutely. So California on the brink of implementing a billionaire, it's called the Billionaire Tax Act. And effectively, they are wanting to tax total wealth of billionaires, and they're wanting to tax 5% of it. And this would potentially be implemented starting in 2027. So now, when we're recording this, it's now less than 12 months away. And yep, Jared, as you can imagine, I am a huge fan of increased taxation. To all of our listeners, we are joking, we are laughing as we say this. Someone actually said this, and this is like Silicon Valley social media saying this, that How absurd that this is dominating the California news on the same week as all of the Minnesota fraud is coming to light. And Jared, I'm sure you're laughing because you've heard me rant for years that before any official fraud hit the news, I firmly believe half of government spending is effectively fraud to begin with. And so I think it's absolutely comical. It's totally insane. They're saying that it's for healthcare. There is truly, and I mean truly, absolutely no way that this solves any healthcare problem whatsoever. And where should we go into the details here next? There's a lot to unpack here.
Yeah, I mean, I think, right, the problem with a lot of legislation is it's passed in isolation, right? It says, hey, there are X number of billionaires. If I charge this, then I'm going to get Y in revenue. But every action has reactions, right? So like the question is the break-even math that probably wasn't done is how many of these people need to leave for this to be a net negative? Right. And which of these people need to leave, right? Because there's a huge, right. There was like a top line, hey, this is going to increase revenue analysis, but there probably wasn't really a tax sensitivity analysis, right? And I know there's already reports of people leaving, and it's really sad, quite frankly, right? I think California's pressing its luck. It's like a very naturally resource rich place, incredible weather. Can't beat that. But I mean, they're just making it very prohibitive. And I think, a couple things like just these like a wealth tax violates like just financial planning law, right? Yes. If I have we looked it up before, there are 400 unicorns in California, right? Startups with value in excess of $1 billion. The problem is okay, and there are in the bill provisions for kind of illiquid assets, and you could, basically pay a loan and all that stuff. And there's kind of workarounds for that. But, right, like all of that value is theoretical until I eat it, right? Until it is in my pocket, it's a wazi, it's a woozy, right? Like if I prepay the wealth tax and then I wake up 5 years later and my company went to zero, do I get a refund of what I paid?
Great question.
Right?
And the answer is no.
Yeah, and the answer is no. So it's just really interesting, this idea of taxation not at the point of value and discretion, but just at the point of California's interest. It's just a really tough pill to swallow, and it just doesn't kind of acknowledge reality as it exists.
That's well put, Jared. A couple things come to mind. One, could not agree with you more. California is the greatest place on earth. There is absolutely nowhere on the entire earth that can rival California when it comes to beauty, weather. I was in California last week. I am planning to be back in California potentially multiple times in the next 6 months. If I could structure my life exactly as I want it, I would probably spend 4 or 5 months out of the year in California. It is the greatest place on earth. And so it's sad to see this happen. It's sad because, Jared, you mentioned the math behind it. So what is the total? What is the net impact on taxation? And I think there's two important calculations. One is, hey, is this going to be tax positive or tax negative? So California should be assessing, are we actually going to be able to get more revenue tax-wise from this? And there's a very, very good chance that it's an enormous net negative, because everyone who would be affected by this tax should leave the state. And then what does that do, Jared? It means that they're no longer paying state income tax. So you have an enormous exodus already. Jared actually put this in our team chat that California, again, ranks number one on migration leaving the state out of 50 states. So no state has seen more people leave than California, which again is truly insane because it is the greatest place on earth. So one, you have a tax negative impact because people are going to leave if they're affected by this tax. And that means when people leave, it's not just that you miss the billionaire tax, it's that you miss the next 40 years of their state income tax. And so that's an enormous negative. There is a second enormous negative, and that goes to your point about unicorns. Several of these unicorns may not even be at the billionaire level yet. They know that they have a very strong chance to be. So personally, the founder of the company may be worth $1 billion, but maybe the founder's not there yet, but he's on a path to be there. It would obviously behoove that founder to leave right now. So it's not just, is this a tax positive or negative event? It could legitimately be a negative event, probably will be. But it's the economic factors that go with, hey, what does it do to your local economy when 200 really successful companies decide that they're going to leave?
Their network effects, they're probably net employers of people.
Yes.
Right? Like all of these things are a huge deal. Yeah, I mean, I think it's interesting too, because like if you look at the bill, it's like worldwide assets, right? Like everything is fair game. And it's
Great
like,
point. Talk about that.
And it's like, here's the thing. If like, hey, the idea, the way it's being pushed is I want a piece of what I helped create. I would argue you created nothing, right? Like the bill, like Brownlee Wealth Management isn't successful because the building made us do what we did. No, we got in and we got clients. But even if you say, okay, hey, I want a percentage of the pie of what I've contributed. No, it's worldwide income. And it's like, okay, so if I'm a founder who set up a company in New Jersey, an industrial company 100 years ago, but I've choose to establish my residence in California, but I'm a billionaire because I own a bunch of assets that aren't in America or aren't in California, I still get taxed on those?
It's crazy.
It's kind of wild, right? But like, I would also use this as a chance to call out the weird fact that America is only one of 2 countries in the world that has citizenship-based taxation, right? Like a lot of other countries, they tax based on, based on where the income is sourced from and where you are a resident, right? U.S. taxes based on citizenship. And the only other country to do that is Eritrea, which is a northeastern African country that has a GDP of, I think, $2 billion, same size as also 1/7 the size of the minimum company in the S&P 500. And they've had a dictator in power since 1993. So it's funny because federally, it is interesting with this idea of like, hey, I'm going to grab everything in the universe, regardless of, even if I can make a logical case that I had some amount of contribution to that. It's kind of interesting that America does that, but also California has just really taken that bad idea that pretty much every other country has rejected and amplifying it even higher.
Right. I did think it was really interesting, some of the responses here. And, I saw some Silicon Valley posts about this, and they brought up PayPal. And, the PayPal mafia is kind of famous in Silicon Valley. Quick 10-second overview. Everyone's familiar with PayPal, but the kind of core 10 employees at PayPal who all held stock, they went on to be billionaires, but then they went on to found a million different companies under the sun. What's crazy is they've also like funded every campaign, and this is like across both political parties. So LinkedIn, YouTube, Tesla, SpaceX, basically half of the enormous, incredible tech companies that we have today.
Trillions in market cap.
Yes, just trillions in market cap. So you think about that, and what if a billionaire tax act was able to kind of break up, and actually New York State, California State really kind of went after PayPal back decades ago? What if they were successful, Jared? And yes, Reid Hoffman, I think, isn't he the founder of LinkedIn? Multi-billionaire. And then, obviously Elon Musk is at Tesla and stuff. And then you have several other tech companies that are included as well. So you have like the whole spectrum. But Jared, how many mom and pop millionaires have those companies created? Just because they were employees at the company and slowly got equity compensation over 30 years.
Yeah. Yeah. Right.
I mean, it's literally millions of people in America came from nothing, and those families are now multimillionaires because they worked at those companies. Now you want an even crazier example? How many people who started from nothing were able to grow their business because of YouTube or LinkedIn? How much does that help Brownlee Wealth Management?
Huge.
I don't know where we'd be without those two things.
But yeah, that's the thing. I think the misunderstanding of the second order effects really matter.
Yeah.
Right. And like, I think the interesting thing about states' rights is, you can vote with your dollars and you can vote with your residency. Sure. And I think, what you're seeing is even a lot of, there's bipartisan opposition to this in California, right? Like, it's not like somebody introduced this bill, but it's not universally adopted by the Democratic Party that's absolutely in control, right? Like, I think people are voting, and it's becoming abundantly clear, like even putting this idea out there is just opening Pandora's box, and it is being universally rejected.
Yeah.
So it'll be interesting to see how that unfolds. So Jeff Kremel, who runs Kermel Strategy Group. He was on the podcast. We'll link to it. He's a brilliant guy, talks about the industry and the profession. He had a post talking about, he looked at the performance of energy companies over 2025. And again, this list is not exhausted, but it looks at some of the biggest players in each of the different parts of the energy supply chain. So we will link to this in the show notes. And I'm not going to go over every single company and tell you its performance, but it looks at a bunch of E&P companies. The best performance is EQT, up 18%. The worst performer is Oxy, down 18%. From just an integrated company, it's got ExxonMobil and Chevron. Exxon is up 12%, or 12% in 25. Chevron is up 4% in 25. Midstream, you have Enbridge up, leading the charge, up 12%. And then Energy Transfer down 17%. Oilfield Services, Baker Hughes up 11%. Schlumberger down 1%. Refiners, Valero up 35%. And Phillips 66 up 13%. So really, the only spot within energy that had positive returns universally is refinery and midstream. Justin, and there's other companies that kind of fill out. I just listed the best and worst performing across each of the different categories. But Justin, as I read that out to you, what do you think? Any thoughts you have about that?
I think a couple of things. It's always incredibly fascinating, Jared, to look at a specific sector and industry and see an enormous delta between the best and the worst. And so there truly is not an ability to just invest in a few companies and use that as a proxy for an entire industry, unless you have a very specific tax constraint that would force you to do that. But you really can't do that. There really is an enormous delta between the winners and the losers. Also just interesting, as we all know, and I talked about this in an interview a couple of weeks ago, it's really just another tough market for oil and gas stocks. We're seeing 21 lagged the S&P, only 2 outperformed, 7 lost money. So all in all, a relatively difficult year compared to the overall market as a whole.
Yeah, so S&P returns 17% over that time. So if you think about the probabilities, looks like 90% chance you lagged.
Yeah.
Less than 10% you outperformed. And then some of these companies, I think 5 of them actually lost money. Right? But I don't think it's interesting because that is the stock market in a nutshell, right? Everybody thinks stock market goes up 8%. Every position's up 8%. No. The attribution is wide. A few companies do really well, some are meh, and then a lot lose money, right? And you win because you don't pick the winners because the winners are in there, right? And so I think it's just a great reminder of kind of being diversified. It's also interesting for our oil and gas listeners, right? We deal with people with a lot of what I would call systematic overweights, right? Hey, I'm sitting on a bunch of ExxonMobil stock. What do I do? And so this is a great testament. It's not just as simple as, hey, I'm gonna buy the S&P 500 and exclude energy, because the performance attribution, energy is composed of all these different categories, and all these different categories have different performance, right? Refiners, the average one was up, probably more than the market. In E&P companies, there's a 50% chance that you're down or flat, right? So if I own, if I own Oxy versus Devon, my return differential is 30%, right? Yeah. And if I would have just excluded S&P X energy, I would have missed out on all that and owned the worst of the few, right? So it's an interesting thought of if I have a systematic overweight in terms of my equity holdings, do I exclude, right? If I own Oxy stock, do I exclude energy altogether? Do I just exclude E&P? Do I just exclude Oxy, right? Again, and it's probably a function of, hey, how much do you have? What's your situation? What other strategies do we have to diversify the stock? But, as you kind of have this reality, it's important to remember, okay, what risk do I actually have? And how do I structure my other assets in light of that risk?
I think that's well put. Jared, it's also interesting. This is a super first grade observation, but it is really critical. When you look at investing in companies, a 20 or 30% up year is normal, and a 20 or 30% down year is also normal. And you have to be able to weather that. That's just wildly different than fixed income, than cash or bonds. You have to be able to navigate that. And, I'll be brief on this, but if we go back to the California point, This is why it's so devastating and why every company that has that type of market cap has to leave the state. Because you could easily find yourself in a year where, hey, we're down 20% this year. And well, if the snapshot for the tax was done before that happened, you're in a completely world of hurt. And for a ton of founders, it would literally bury them.
Yeah. There is one beneficiary of the California wealth tax. It's all the people that are going to be required to get approved valuations.
Yes.
Right. If there's one person that's going to win from that, or one group of people, it's probably the lobby of private appraisers.
Yes, the valuation appraisers.
But I mean, it just gets back to this idea of like, hey, most stocks underperform the aggregate market, right?
Mhm.
And it's power loss. 80% of the results are driven by 20% of the stocks, the best performing stocks.
Right.
And so, like, it's just a great reminder to diversify. And again, right? Like, if oil had a better year, all of these numbers would look better, but the attribution is still wide between the best and worst performer. And so, love Jeff's research. We'll also link to it and the episode we had with him. Justin, I think the most important piece of economic news, final one we should wrap up on, is the recession, the slop bowl recession that nobody's talking about. That's just catastrophic. Tell us what is a slop bowl?
So slop bowl has become kind of the funny Wall Street term for Chipotle, Cava, sweet greens. So you get the idea. You go to lunch and you just get a bowl of something from those places. What are we seeing there, Jared? We're seeing some really bad stock performance recently. And what's going on with the slop bowls?
Yeah, I mean, it's a recession, right? So like this chart is a couple months old, but Cava was down 57% from all-time highs. Sweet Green was down 82%. Chipotle is not on here, but I think Chipotle was also down probably close to 50%. These companies are just struggling, right? Despite like, it's interesting because like you see, and it's just such a testament to the disconnect between stock price and economic conditions, right? It's all about what's happened relative to expectations. All of these things are proliferating like wildfire, right? Like they're everywhere. Everywhere I go, it's like there's another one being open. They're expanding their footprint massively. But right, like, and again, I don't know why it's happening to each of these, but they're all sucking wind, right? Because not because they're doing bad and not because they're not growing, but just because the expectations about their future growth were so high.
That's a really good point, Jared. We talked about this idea with real estate, and it's true in a lot of industries. Whenever you see a certain asset class explode in value in a very short period of time, it is possible that you were seeing their next 7 years of returns all being gained in the first year, right? So how much did we talk in 2023 that, hey, this decade's improvement in price appreciation for real estate, it may have already happened. So we could be flat from here to 2030, and it's still a kind of good decade in real estate. So there's some of that dynamic as well. And you just alluded to this. They maybe saw so much growth in a short period of time that they were pricing in future growth. And sometimes when that future growth can't quite happen at the rate that they expect, well, then it's going to, set up for an enormous downfall.
Yeah, and it's just a function of CapEx, right? Like the only way that these companies grow their top line is expanded number of units, so stores, or expanded sales. And like those are much harder levers to pull than like a software business. Right? So like naturally you're gonna get punished. And like to be clear, I like Sweet Green. I like Cava. I think they provide a valuable service, especially as a family with children under 5. The fast casual, healthier experience is like awesome. But the thing is like Sweet Green, for example, I don't know if they've turned revenue neutral, or profit neutral, but like for a long, they've been in business a long time and they've just lost money.
Yes.
And the goal has been to scale up to a certain size. And that's when it's really easy to lose any sort of momentum, is when your ability to actually make profit is predicated on aggressive growth. And if that aggressive growth can't materialize, the entire business plan just went out the window.
That's a great point.
So as someone who goes to the Sweet Green with quite regularity, I'm rooting for a rebound, a slop bowl rebound.
Can I admit something?
Yeah.
I've never been to Sweet Green. I've been to Cava, and obviously I've been to Chipotle a bunch.
I think Sweet Green is the best of the 3.
Okay. I need to check it. Do we have one here near the office?
You live so close to one, man. It's on University.
Really?
Yeah.
Wow. So I have one right by my house. I need to check this out.
Yeah, you live closer to that Sweet Green than I do.
Okay, we will keep our listeners posted on my personal thoughts on Sweet Green over the next month or so, and look forward to reporting back on that.
Yeah, well, that's all we got. Again, listeners, we're grateful for you. Like, share, subscribe, keep sending us emails. We love hearing from you guys, and we're grateful that you've chosen to go along the journey with us. Ideas for future episodes, or just want to say hi, podcast@brownleewealthmanagement.com. Thanks. We'll see you next time.